That's the phase 1 correction of the banana zone. Phase 2 of the banana zone, we're still in it. We've barely started it. The phase 2 correction should come from much higher, pulls back and then goes higher. This is not the phase 2 correction. This is still part of the banana zone. So there we are. It's just like the banana zone doesn't look obvious. We had all this shit here too. But when you look back on that chart, it's like, oh yeah, it's a banana. And you go back here, oh, it's a banana. But you would have been going, see, it's all over. You've never called the banana zone. You've got it all wrong. It's stupid. All of this time, all the way up, you'll have done the same thing. But when you go back and look, they're banana. Now, this banana is going to be longer in time, so therefore less spiky in price at this point.
Raoul explains that we are still in phase 2 of the banana zone, a period where markets move higher with brief corrections along the way. He notes that this phase is often misunderstood, as many mistake normal pullbacks for the end of the cycle. According to Pal, the current correction is not a top but a healthy reset before the next big move. He believes global liquidity and easing financial conditions will soon push markets into the next leg higher. Looking back at previous cycles, Pal says the pattern is clear. Each run forms a long upward curve that only looks obvious in hindsight. This time, he expects the move to last longer, be less volatile, and potentially more powerful once liquidity accelerates again.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
The business cycle. The business cycle is the daddy that drives earnings in the economy and is the kind of arbiter of economic growth. The business cycle has been lackluster. As you know, the ISM survey has been slow. The ISM survey is actually driven by liquidity, which leads by 6 months. Liquidity has been relatively choppy on a year-on-year basis, on a global basis, but ahead we should start to see ISM grow. Note the little hook down in liquidity that's currently happening. Oh, that seems to correspond with other things that are going on right now, but that's a forward-looking thing. So liquidity has been pulling back somewhat, but we expect the business cycle to start to grow. Obviously, we've got this government shutdown. I'll come onto that in a sec. That may still kind of cause another month or two of weaker ISM because of the government sector. Maybe not. We'll have to wait and see. I'm indifferent to it because we know where it's going. And behind this indicator is probably 50 to show a lead on this. But what's important here is the GMI dominoes. And this is the liquidity cascade. Out in the future, in this lovely, attractive purple color, is the GMI Financial Conditions Index. That lives 9 months ahead of anything of the ISM. That is what leads it all. That's driven by interest rates. It's driven by commodity prices. It's driven by the dollar. And that has started weakening after a period of consolidation. So weakening here is this going up because it's inverted. So what we've got is easier financial conditions are going on. And we've seen that as rates have started to fall. So that is going on. That leads total liquidity by about 6 months. Now, there's a bit of a shifting lead lag here, but either way, we're expecting global liquidity to now follow GMI financial condition. Does global liquidity have another down month? Probably, possibly, maybe 2 months. No, I think it's a month. And then what happens is it hooks up with financial conditions as we go into the end of the year. So October would print as a weaker month, obviously because of what is happening with the US government shutdown, where there's less liquidity being pumped in the system. But I'll come to that. And then the ISM follows suit. The ISM is where, when we get above 50 and start expanding, is where alt season is. It's where the Russell 2000 breaks out. It's where the small caps start going. It's where the riskier credit starts moving. That's the real game in town. You need a booming economy and lots of liquidity to drive the money shot. The way you can make money by just throwing a dart on your screen and whatever it hits will go up. That's to come. Those are the banana zone points when things really accelerate. It's all coming. It's a matter of patience. Don't forget, the ISM has 1 data point a month, and you think you're trading it with your tick charts on your screen. You are sadly deluded. That's not how this works. So hence why you just kind of do nothing and let this play out. We've got the game here. The game here is that. The game here allows the asset prices to move because total liquidity is the thing that drives Bitcoin and the NASDAQ, which are the things we really care about. Interestingly, gold actually follows, or actually is basically current financial conditions. So financial conditions and gold are all in the future. And so when you look at gold against total liquidity, it's telling you liquidity is about to explode. And that's a really interesting thing. Gold has shifted around. Sometimes it's real rates, and other times it's other things. Other times it's just the dollar. But right now, gold's highest correlation in this kind of Bayesian world where probability shift and correlation shift is it's all about financial conditions. And it's basically telling us the financial conditions here are going to explode weaker. Okay, super interesting. Will it work out exactly like this? Hell no. Will it be rhyming? Hell yes. So liquidity's rising. Okay, so what's really going to push a massive rise in liquidity? Well, hello, the PBOC. We've been using this chart of the Chinese central bank balance sheet, which is the only major government using their balance sheet right now, versus 10-year bond yields with like a 2-year lead. And it's been working perfectly since we started pulling this out in 2022. And what it's suggesting is we're now in the acceleration of the use of the PBOC balance sheet. Balance sheets are like the most powerful force multiplier. Somebody's going to be using one somewhere. Back in 2017, it was the Chinese that drove the entire crypto cycle because the US was tightening rates. And it was doing QT. I mean, all of the bad things, all overridden by the fact that the PBOC, the UK and the ECB all stepped on the gas. The PBOC is going to be stepping on the gas. Interesting. Look when it peaks. It peaks in 2026. That's super interesting. We also know that gold leads by a significant period of time, about 12 months versus ISM. And that's telling us that, in 12 months' time, we're still not peaking the business cycle. Has gold peaked today or not? I'm not sure. I still kind of think it goes another leg from here, but we have some more volatility, more correction, another leg higher. I'm indifferent to it. I'm not in the gold trade right now. But what it does is give us a lead on the cycle. So go back to the gold chart. This is the chart that everyone on Twitter has got a different time horizon for. This is the one we've been using. I've not really shared it super publicly, but this is gold with a 188-day lead, so 6 months lead versus Bitcoin. It's a stunner, right? It's an absolute stunner. So as of tomorrow, every single fucker on X is going to be using this chart and claiming it's theirs. If you would just remember, now the problem with this one, it's not the pink GMI one. So if you see this, just make sure that it's our chart because I've not seen this one. Everyone's using like a 90-day one or a 60-day one. This is the one, I think. What we've got is a slight divergence against, I don't think you can see my mouse, but there's a slight divergence versus that chart. And that doesn't look anything on the chart. I mean, it's noisy, right? Nothing fits perfectly. Keep trying to say this 1,000 times and everyone goes, oh, why did that chart break? It's like, morons, please listen. You're not serious people. So what it suggests to me is we have catch up to do, and that goes into the end of the year. And then we'd have a period where everyone says the cycle is over, and what happens is nothing. The bears get really aggressive and it doesn't work. The bulls get miserable and start questioning their own lives and whether they fucked this whole thing up, and nothing happens. And then eventually, April, May, as ever, it explodes higher again. That's what this is telling you. I think this is probably the closest estimation in my head and what I think plays out. Let's go to April 17 to 18. There's a similar pattern here, similar kind of part in the cycle. Obviously, we think the cycle extends, but there is similarities, and we've got alligator jaws. Oh no, alligator jaws. What normally the alligator jaws will do is Bitcoin should be at about 140,000 now, but it's not. So it's diverged a bit. Oh, it's all broken, it's failed. No, I'll explain why. Because there's always reasons why things are different. Here's Bitcoin 2020 versus 2021. This seems like it's the right point in the cycle versus the previous chart, which was the final year of the cycle. This is the prior year of the cycle. And what we've got is this divergence again. I mean, look how beautifully tight that correlation is. Alligator jaws.
Raoul Pal says we're still in phase 2 of the banana zone, where temporary pullbacks are just resets before the next upward surge. Easing financial conditions and rising liquidity are expected to drive the market higher. Looking at past cycles, these long upward moves only make sense in hindsight. Pal expects this phase to last longer, be smoother, and even more powerful as liquidity grows, showing the banana zone is just getting started.
And we are at the second lowest bandwidth of Bollinger Bands in history of Bitcoin. Okay, so it's interesting. And interestingly, it reverses soon after. And interestingly, it always produces higher prices. And we pointed this out the last 2 times it happened. And the last 2 times it happened, it went up 107%. 260 days later, so whatever that is, 9 months. And it went up 125% 9 months later then, even though it had been much higher than that. And then back in 2016, which is like a similar period to now, it was up 189%, and it had been up over 200%. So the point being, these compressed Bollinger Bands, John Bollinger, I think, was on X talking about this, is like, these are an opportunity. Okay, seasonality. We're at a really good point in the seasonality chart. And you would imagine that we are now diverging from this because of repeat after me, the Treasury General Account and the government shutdown. Once that comes back in, we start climbing the curve to the end of the year. Does it start in November and we play catch up? Either way, we should have a back end of the year that's very strong. And in the end, he'll have forgotten all about this shit, much like we told you in April 2024, September 24, April 25. I mean, it's all the same shit. You forget about it after a while. Russell 2000. Think of Russell 2000 as, remember I mentioned it before, a reflection of the business cycle and highly correlated to alts. Alts, Russell 2000, you are around this level here, and you generally have a bit of weakness. November, up only into the end of the year. That is so common that I remember hedge funds trading this back when I was back in NatWest. So we're talking 95, 94, there was a hedge fund, Everest Capital, based out of Florida. Every year, a trader would come on and quote huge size, these call spreads where he sold puts in the indices because in the last couple of months of the year, because he figured out this pattern. Most people weren't really looking at it, and it worked 60, 70% of the time. It was a great fucking trade. And he did it every single year I knew him. And here's the trade. That's the seasonality. That's the seasonality. Remember, it's a liquidity-driven seasonality, and Bitcoin gets driven more than the Russell 2000, and it gets driven more than the NASDAQ. But the NASDAQ's more than the Russell 2000. That's where we are with the NASDAQ. So it's kind of November, December is where all the real gains are. So look at this. Seasonality is you kind of make no money from like August all the way through to November, and then you make a shit ton of money into the end of the year. Bitcoin. Oh, look, you don't really make any money all of September and October. And then somewhere in October, normally it's around the 16th, but this has been delayed because, repeat after me, the Treasury General Account and the government shutdown, it's been delayed a bit. And then you get November and December. These are the months that make all the money. Now here it says, well, the market's normally peaking in the end of November. I would go back to this chart and say, I think this is more likely, where it peaks into January. And we've got many other charts that suggest it's like Jan, even Feb, where it peaks and then trades sideways into April or so and then goes higher again. So that's what we're looking at. Now, remember, for God's sake, we don't know whether this happens or not, whether this happens or not, or any other fucking variation. It's probabilistically what we think plays out. So if you do get a big, nice leg where Bitcoin seasonality here, now these are including old cycles, so it's exaggerated in price terms, but let's say it goes from 300 to 900, goes up 3x in 2 months. Let's halve that, goes up 1.5x or 1x. That's when you take some lifestyle chips off in case we fuck this up. That's a bit where you're like, I don't really care if I've got it wrong. Or you buy some short-term puts because remember, volatility is super low. Right now, you should be buying calls because volatility is very cheap. IBIT calls. You should all own IBIT calls. That trade recommendation's been in Real Vision Pro and GMI for a while.
Raoul Pal says the crypto market is still in phase 2 of the banana zone, where short-term pullbacks are normal pauses, not the end of the cycle. With rising liquidity and supportive macro conditions, the market is set for the next leg higher. He notes that past liquidity signals, like in 2022, predicted major gains in assets such as Solana. The current phase is expected to be longer and smoother, offering opportunities for patient investors. Is this pullback a major correction or just a pause? How are you preparing for the next phase of the banana zone?